Greetings. Welcome to The Venturist. Currencies play a crucial role in our daily lives and in the global economy. Every day, they rise and fall in value, affecting everything from international trade to the price of a cup of coffee. But what causes these fluctuations, and how do they impact us? In this video, we'll take a closer look at why currencies rise and fall in value. We first need to understand the basic principles of supply and demand. Just like any other product or commodity, the value of a currency is determined by how much people want to buy or sell it. When there's a high demand for a currency, its value will increase. And when there's a low demand, its value will decrease. One of the main factors that drives the demand for a currency is the country's economic performance. When a country's economy is doing well, investors and businesses will want to invest in it, driving up the demand for its currency. This, in turn, will lead to an appreciation in its value. Conversely, when a country's economy is struggling, people will want to sell its currency, driving down its value. Another important factor that affects the value of a currency is interest rates. When a country raises interest rates, it makes it more attractive for investors to put their money there, as they'll earn more in interest. This increases the demand for the country's currency and can cause its value to rise. In contrast, when interest rates are lowered, the value of the currency may decrease. Additionally, central banks can also buy or sell their own currency in the foreign exchange market in order to influence its value. For example, a central bank may sell its own currency to try to weaken it and make the country's exports more competitive. Such interventions can also cause the value of a currency to fluctuate. Other factors that can impact the value of a currency include political stability, natural disasters, and even market sentiment or investor sentiment. Political instability can cause a lack of confidence in a country's economy and its currency, leading to a decrease in demand and value. It's also worth noting that currency values are closely tied to other financial markets, such as stocks and bonds. When these markets are doing well, investors tend to have more confidence in the global economy and are more likely to invest in higher-yielding currencies. Conversely, when these markets are struggling, investors tend to be more risk-averse and will often flock to so-called safe haven currencies like the US dollar. In conclusion, the value of a currency is determined by a complex set of factors, including supply and demand, economic performance, interest rates, and central bank intervention. Understanding these factors can help us to better predict and understand the fluctuations in currency values. Be sure to subscribe and hit that notification bell if you'd like to support the channel and learn more about the way the world works.